Good afternoon. It's a real pleasure to be here in Seoul. Everybody, of course, is interested in the dollar. And when I started writing this book back in 2013, I had planned to tell a story about the dollar. But as I started looking at the data, it turned out that the story was not quite what I had expected. Given that the financial crisis had its epicenter in the United States, and since the financial crisis, the US Federal Reserve, the US Central Bank, essentially printed a lot of dollars, and the US government issued a large amount of debt, it would have been logical to expect that the US dollar would lose its prominence as well as its value. And then as I started looking at the numbers, a very strange story came before my eyes. And that's what the book turned out to be about. It's a story of many interesting twists and turns and paradoxes. So consider this. As I mentioned, the financial crisis started in the US, and since the financial crisis, the US government has issued about $6 trillion worth of publicly held debt. This is excluding the debt held by the other parts of the US government and by the Federal Reserve. $6 trillion between the end of 2007 and today. And who bought this debt? It turns out that about $3.6 trillion, nearly 60% of that debt, was purchased by foreign investors. Foreign investors essentially were buying the debt of a country that had precipitated the crisis and that had issued an enormous amount of debt in order to get itself out of the crisis. Now, this seems like a very strange outcome. Typically, when a country is in trouble, either because of its financial system or if it issues a lot of debt, then typically investors tend to run away from that country's debt and from that country's currency. But in this case, quite the opposite happened. And this is not the only instance, as it turns out. Every time there is turmoil anywhere in the world, in Europe, in the emerging markets, or, and this is the great paradox, if there is trouble in the US itself, money comes to the US looking for safety. There are many examples of this. In August of 2011, Standard & Poor's, the rating agency, downgraded US government debt. Typically, when the debt of a country or a corporation is downgraded, what happens? Yields on that debt rise, and if it's a country, that country's currency loses value. What happened in the US case? Between August of 2011 and 3 months later, the yield on the 10-year US government bond actually fell by 1 percentage point. In October of 2013, there was the prospect that the US government might default on its debt. Now, certainly it was going to be at most a technical default and a short-lived one, but anytime there is prospect of default on a country's or corporation's debt, again, yields tend to rise. And what happened in this case? Yet again, as in many other instances, in this case, the yield on the 10-year government bond actually fell by about 30 basis points from the end of September to about the middle of October, when there was a possibility of the US government default. What is going on? It turns out that there is a simple story at hand, and like a lot of things in economics, it comes down to supply and demand. But supply and demand in this case of one very specific thing, which is safe financial assets. So what is a safe financial asset? It's basically one where an investor can at least hope to maintain the value of the assets, the principal value, even in very bad times, and one that is fairly liquid or easy to trade. And what instruments have this characteristic? Largely the government bonds of the advanced economies. So what happened after the financial crisis is a very large increase in the demand for financial safe assets. emerging market countries in particular want a lot more foreign exchange reserves or safe assets to protect themselves from capital flow and currency volatility. In 1999, after the Asian financial crisis, emerging markets as a group held about $500 billion worth of foreign exchange reserves. Today, they hold $7.5 trillion. That's an increase of $7 trillion of foreign exchange reserves, largely held in advanced economy government bonds. Second, private investors want a lot more safety when there is a lot of turmoil. And in the aftermath of the financial crisis, financial institutions, especially banks, are being asked, for very good reasons, to hold a lot more financial safe assets. So the demand for financial safe assets has increased very sharply. And at the same time, the financial crisis hurt the supply of safe assets. The Eurozone isn't quite what we think it was. If you take what one might consider the safe part of the Eurozone, that accounts for only about 40% of overall Eurozone debt. Of course, the periphery is still in rather weak condition, and even the core, the safe part of the Eurozone, includes countries like Austria and France that have had downgrades of their sovereign debt. There are other countries like Japan and France and Switzerland that are traditional havens of safety, where investors look to put their money for safety. Japan and Switzerland don't want money coming into their economies, and in fact, they have become net demanders rather than suppliers of financial safe assets. And then, of course, there are very few private securities that are considered safe anymore. In the US, there are just 4 corporations that still have AAA-rated corporate debt. So this is what the financial crisis has created. A huge increase in the demand for financial safe assets, a huge reduction in the supply, and who was left to fill in the balance? Well, very graciously, the US government stepped in to fill the breach. And this is why investors around the world have been flocking to the US Treasury security markets for safety. Now, at this stage, one obvious question that arises is, why aren't there alternatives? Why is it the case that if there is such a demand for safety, such a demand for financial safe assets, that there aren't other currencies that step in to fill in the breach? The euro, when it was created back in 1999, was seen as a viable competitor to the US dollar. Now, one measure of how important a currency is in global financial markets is the share of foreign exchange reserves held in that currency. Before 1999, if you took all the currencies that became part of the Eurozone, they accounted for about 19% of global foreign exchange reserves. That number started rising after 1999, and it went all the way up to about 28%. And that came out of the dollar share. So many people at the time saw the dollar share going like this, the euro share going like this, and predicted that the two lines would soon cross. But as it turned out, after 2004, those lines flatlined. It turned out that Eurozone debt markets were not quite as deep and liquid as people had imagined. And now, of course, after the Eurozone debt crisis, the euro is hardly in shape to compete with the dollar. It has enough trouble just keeping up with itself. And the share of global foreign exchange reserves denominated in euros is now down to about 22-23%. Like I said, Japan and Switzerland are traditional safe havens, but they don't have the depth and liquidity in their markets to compete with the US. That leaves one very intriguing potential competitor, which is the Chinese Renminbi. The Chinese Renminbi at one level has no right to even be considered a reserve currency because despite the move that the People's Bank of China undertook on August 11 to free up the currency, still the renminbi is not a market-determined currency and China doesn't have a fully open capital account. China also does not have very well-developed financial markets and it's a bank-dominated system without very much government debt or other fixed income securities that foreign investors can have. So it seems odd to even think about the renminbi as a reserve currency. Now here is the remarkable thing. Even though the renminbi does not meet the prerequisites of a reserve currency, it has already become a reserve currency. There are countries around the world, from Chile in Latin America to Nigeria in Africa to a whole host of Asian economies, including Korea, Malaysia, Thailand, Japan, all of which have indicated they already hold or plan to hold a small portion of their reserve portfolio in renminbi-denominated assets. There are about 34 central banks around the world that have signed local currency swap arrangements with the People's Bank of China. What do these arrangements give them? Not access to dollar liquidity, but access to renminbi liquidity. So looking at this, the fact that China does not meet the prerequisites for a reserve currency, but is already on its path to becoming a reserve currency, some people have argued when China does have a fully open capital account, when it does have a fully flexible exchange rate, the renminbi is taking over. I do not agree with that view. Why is that? First of all, if one looks at what has happened with these bilateral currency arrangements and many other trading arrangements that countries in the Asian region in particular have signed with the People's Bank of China, how does one view them? I would argue that these are essentially a very low-cost bet that these countries are making on a currency that is certainly on its way to becoming an important international currency. Everybody wants to be friends with China. The big question is whether the renminbi can ascend from being a reserve currency to being a safe haven currency. And to my mind, what is very important is not just economic size, not even just financial market depth, but institutions. So what do I mean by institutions? Now let's step back a little bit and consider the US case again. So if you take the US government's public debt, the US government now has public debt of about 18.1 trillion US dollars. That's a little over US nominal GDP, a little over 100%. Of this, about $5.1 trillion is held by other parts of the US government, including the Social Security trust funds. The Federal Reserve holds about $2.5 trillion. That leaves about $10.3 trillion. Of this $10.3 trillion, foreign investors hold $6.1 trillion, about 60%. That number, 60%, is much greater than any other reserve currency economy. In the case of Japan, about 11% of net debt is held by foreign investors. In the case of the Eurozone, it's a little difficult to figure out because there are lots of holdings of Eurozone debt by countries within the Eurozone. But the European Central Bank estimates that about 17 to 18% of Eurozone debt is held by investors outside the Eurozone. So the US is very special. And you might think it would create temptation for the US to inflate away the value of its debt. Because after all, if the US debt, which is denominated in dollars, could be brought down in terms of inflation-adjusted value by the Fed essentially printing dollars, yes, domestic investors would get hurt if there was an increase in inflation, but foreign investors would get doubly hurt. Not only would they suffer a fall in the capital value of those bonds, but the US dollar would almost certainly depreciate. So why is it that foreign investors have this almost childlike faith in the US? This is where the institutions come in. If you think about who holds the other $3.6 trillion of US government federal debt that is not held by foreign investors, who holds it? It turns out it's held by pensioners, retirees, local governments, insurance companies, all of which have a lot of political power. So for a foreign investor looking at this, it's a logical presumption to say, yes, there is a temptation for the US government to inflate away the value of its debt, but the government would pay a big political price for it. Now, I spend a lot of time in Washington, D.C., and you might think I'm deluded and I'm fooling myself if I'm arguing that the US political system works well. In many ways, it does not. But over a long span of history, the remarkable thing is that the US does have a system of checks and balances and does have a self-correcting mechanism. Over time, the US, through some blundering process, gets the right thing done. So there's one part which is the political system that it responds to domestic pressures. Second, there is the legal framework. One might argue, maybe the US could say, I don't want to hurt my investors, but I'm going to hurt foreign investors. Maybe the government will just not pay back part of what it owes to China. Here, the legal system becomes very important because it turns out that the US, by law, cannot treat different holders of its debt differently. So everybody who holds US government debt, whether you're domestic, foreign, whether you're a government, a private citizen, has to be US government debt, whether you're domestic, foreign, whether you're a government, a private citizen, has to be treated equally. The legal system becomes very important in this case. There are not that many countries in the world where the government can get taken to court, and sometimes, in fact, reasonably often, the government loses because the government has to play by exactly the same rules that everybody else has to play by. So the legal system is another important aspect. And the third aspect is public institutions like the Federal Reserve that are independent and that are seen as trustworthy by the rest of the world. So if you think about what I call this magic sauce that the US has put together, it's not just economic size, it's not just very deep and liquid financial markets, but also this combination of institutions, an open and transparent democratic system of government, very good legal institutions, as well as public institutions that have the trust of domestic and foreign investors. That's what keeps foreign investors coming to the US for safety. So if one thinks about China in this context, I would argue that China is putting in place the economic reforms, the financial market reforms that are necessary to support the renminbi's becoming not just an international currency, that is one that is widely used in trade and finance transactions, but also a reserve currency. But I do not think it will ascend to the status of a safe haven currency unless China is willing to undertake not just economic and other market-oriented reforms, but a much broader set of institutional and legal reforms. And I don't think that's going to happen. So on the renminbi, my prediction is that it will erode but not seriously displace the dollar's dominance in international finance. Now, at this stage when writing my book, I was confronted with a dilemma. Because one thing I have noticed is that books sell very well if they say the world is going to collapse or something terrible is going to happen. And it seems logical here because after all, this should not be going this way. The US dollar should not have this role of prominence, and it seems like a very, very fragile state, especially if one thinks back a few years. Right after the financial crisis, the US economy at that stage was not doing well. It was issuing a massive amount of debt. So one would think that this all had to end very badly, that the US dollar would have to collapse when international investors came to their senses. But try as I might to lay out a disaster scenario where things would come apart, I couldn't. And it wasn't for lack of trying. One example could be maybe China decides it holds a lot of US government treasuries. Officially, the number is about $1.3 trillion right now. In reality, it's probably more. And China might say, maybe there is some tension in the South China Sea. So the Chinese government says, it's okay. I know it's going to hurt us, my citizens, a little bit, but I'm going to teach the US a lesson. One doesn't even need to think about international shocks. One could think about US investors saying, the Fed has printed a lot of money, infused a lot of liquidity into the system, and yet the inflation rate stays very low. And even if you look at the Treasury inflation-protected securities market, inflation expectations, all of those suggest that inflation expectations are still around 2% over the medium term, if not slightly lower. But one day, bond investors might wake up and say, oh my God, this cannot possibly last, and the Fed has still not moved. There is big inflationary risk. I better start getting out of US government debt. And the one thing that the financial crisis has taught us is that very often we don't anticipate where the shocks are coming from. And even if we anticipate the shocks, like the US housing market meltdown, we don't anticipate the cascading effects it could have that create a financial crisis from one shock. So any of these things could happen. Now, here again is the remarkable thing. Think about it. If you had a scenario where there was turmoil in the US government bond market, what would happen? Here again, the financial crisis teaches us that it would most likely spill over into other US financial markets. And when there is trouble in US financial markets, what would happen? It would very quickly spread to financial markets around the world. And if that happens, what would everybody look for? Investors around the world would look for safety. And where do you go to get that safety? Well, back to the US dollar. Simply because there is no other place to go right now. And I think that's a reality face. And again, this is not a figment of my imagination. If you think about what happened recently when there was tension with Russia about Ukraine, the Russian foreign minister actually made this explicit threat. We hold a few hundreds of billions of dollars worth of US treasuries, and if the US doesn't play nice with us, we are going to dump those US treasury securities. What happened to US government bond yields? That day, when the foreign minister made a statement, nothing. 2 days later, US government bond yields were even lower. Why? Because people logically ask the question, so China takes $100 billion worth of treasuries, and where can it possibly go? It can't go into the gold market because it would drive that market berserk, and Russia would probably face losses. The Eurozone market right now is in no shape to absorb that kind of liquidity. And as I mentioned, Japan and Switzerland don't seem to want the money coming in. So there is really no alternative. But this also brings up two very important points that I want to make. One is that my story is not necessarily a story about US exceptionalism, that the US economy is very strong and is likely to remain the most dominant economy in the future. If China remains on its present growth track, it could well be the case that even at market exchange rates, sometime in the next 1 to 2 decades, the Chinese economy becomes larger than the US economy. So my point is that in international finance, everything is relative. And relatively speaking, the US economy is still in the best shape given all the other advanced economies in particular. But this combination that it has of economic size, financial market depth, as well as very robust institutions is going to be extremely difficult for any other country to match. The other point I want to make is that this does not mean that the international monetary system is working very well. In fact, in addition to weaknesses in other economies, I think this points to fundamental weaknesses in the international monetary system, that there aren't any good alternatives to the US dollar, that there is so much demand for safety that emerging market economies feel that they have to protect themselves from all of this volatility. So my sense is that this is really pointing to weaknesses in the international monetary system as well as in the financial structures of many individual countries. So what does all of this mean for a country like Korea that is caught between these crosswinds? I think the harsh reality for many emerging market economies, especially those in the Asian region, is that this is going to be a period of enormous volatility in currencies as well as capital flows. If you think about what the US is doing or not doing, who knows how much longer this uncertainty is going to last? A great deal has been made about when the Fed actually starts moving with its first rate hike. And right now, the probability that it'll move in December seems to be somewhat lower than it was even a couple of weeks ago. To some extent because of weakness in the rest of the world, to which the Fed seems to be paying a little more attention than in the past. And US data seem to be coming in, again, somewhat mixed as they have been for a relatively long period. But of course, the biggest issue about the US is that even though the labor market does seem to be showing some signs of tightening, at least in terms of the unemployment rate, which is still around 5%, and job growth has been decent, if not spectacular, there is very little sign of wage pressures or inflationary pressures. So the question still hanging before the Fed is, why exactly should they move, especially given that there is weakness in the rest of the world and given that asset market imbalances that some Federal Reserve governors had pointed to earlier in the year seem to have dissipated to some extent. But no matter what the Fed does, it is likely that you will have more monetary easing coming from the Bank of Japan. So for a country like Korea, I think it's going to be a very complex combination. And what has been happening to the Korean won is, I think, a perfect paradigm for this, because over the last year, it has appreciated in terms of the real effective exchange rate, but in recent months, it's depreciated against the dollar and appreciated against the Japanese yen. And now with the Chinese Renminbi likely to float down further if in fact the PBOC does allow the currency to actually be more determined by market forces, then I think it's going to be a very complex environment in the Asian region. Fortunately for Korea, I think this economy is in much better shape than many of your neighbors to deal with these forces. You still have room in terms of policies. If you take monetary policy, the policy rate now is at about 1.5%, and with inflation at about 0.5%, that still leaves you some room to move in terms of the real interest rate. And of course, you're not quite at the zero lower rate bound yet. In terms of fiscal policy, yes, the way the Korean government computes the fiscal deficit, it's about 2.2, 2.3% of GDP, but the way the rest of the world, including the IMF, would calculate your fiscal deficit, excluding the social security funds, it would be a surplus of about 0.3%. So I think there is a lot of room in terms of macro policies to deal with these shocks. Plus, if one looks at the vulnerability to external shocks, the fact that you have about $360 billion worth of foreign exchange reserves and the exposure to dollar-denominated corporate debt is not that high. I think Korea is in a somewhat better position to manage these very difficult cross currents than many other economies in the region. But I think the prospects for the next few years are indeed ones of enormous volatility, where if anything, the dollar is going to remain strong or potentially strengthen further. And at least in the short term, I think the capital flow dynamic is going to overturn the current account surplus dynamics in China leading to the renminbi, if anything, depreciating, although over the medium term, one could still make the case that the renminbi still needs to appreciate in order for domestic rebalancing and given where the current account surplus is likely to go. So I don't think there are any easy answers. I think the fact that at this stage, the dollar remains so dominant is a sad tale about international finance. But let me leave you with one final thought, which is think about a scenario, a better world where perhaps you had multiple currencies, including the euro and the renminbi, also playing roles similar to the US dollar. That would be good for the US at one level and for the world economy because it would mean a lot more discipline on US macro policies. But if we had another financial crisis and there were multiple currencies and not one anchor currency that everybody could turn to, perhaps, just perhaps, things could have been a lot worse because that was a time when the very basic elements of trust were breaking down. So perhaps it was not such a bad thing, given that the world financial system still remains in this very fragile state, to have one very dominant currency. So it's not great to end a talk like this on this somewhat pessimistic note of it could have been worse. But I think that's the reality we face today. Unless economies put in place the structural reforms they need to improve their competitiveness, their financial systems, unless the world can get together and come up with a better international monetary system for the foreseeable future, I think we are all pretty much stuck in the dollar trap. Thank you.
The World Knowledge Forum